So thank you for joining me at the Data Explorer's Daily Market Update, and let me try and entertain you today under a piece with the heading "An apple a day and some corporate bonds helps keep the doctor away," which was a convenient pun to do with the fact that holding Apple is basically the most common way to ride through this tempestuous time in the stock markets. It forms about 15% of a lot of fund managers' portfolios, is this the place to hide? And given that you can only own so much of Apple's shares, and that the entire mutual fund world cannot entirely rely upon Steve Jobs for their investors' money, where else are they going to be hiding? Well, obviously gold and Swiss francs people are going into. Well, gold, I think the ever-wise FT Lex points out that gold is attracting as much retail money as anything else, and could be massively overvalued and set for a fall, some would say. Then there's the Swiss franc. Well, Swiss franc is incredibly strong, but what happens if the Swiss central bank, like they did this week, decides to intervene and sell Swiss francs to bring it down? You're going to get big currency gyrations, so even the Swiss franc's arguably not that safe. Well, we can see evidence that long-only funds have been piling into corporate bonds, not surprisingly, with companies stuffed full of cash like turkeys in December. They're going to be able to basically pay the interest on these corporate bonds and redeem them. And that's where a lot of the smart money has been going. On a global basis, the global corporate bonds, 20% more of the assets held by those funds who lend have put 20% more of their money into global corporate bonds since January, which is a big, big move. That's mainly gone into European corporate bonds, with a 38% increase since January for that particular asset class. Quite ironically, though, in the top five, there are Unicredit, Banco Popolare, and Commerzbank. I say ironic, given that these are slightly, someone would say, distressed European banks, but people are long their corporate bonds. And then if you go into the US, only a 12% increase in the amount of money in investment-grade US corporate bonds, but that is a big value movement. That's about a 15 billion swing into that asset class. What is that? Well, it's clearly mainly banks like JP Morgan, Goldman, PNC Financial Services. These are the top corporate bonds being held, and the one non-bank in there is good old GE, paying a sort of 5 or 6% yield, which looks like a pretty sensible thing to own from what little I understand about the stock market. Finally, the UK, 18% rise in the amount of UK-denominated corporate bonds being held, with most of the top ones being utilities. Maybe after Hong Kong's richest man and the suitably named Li Ka-shing because he's cashing so much money as he bought Northumbria Water, maybe people think that these utilities are going to get basically taken out and the bondholders will get their money back early. Because I wonder why they own these things, because they only pay about a 2% yield. Anyway, it's a report in the usual place. If you'd like to read it, please go to dataexplorers.com/news.